Have you ever heard that saving money is only for the wealthy or that credit cards are always bad? Money myths are everywhere, and they could be holding you back from achieving financial success. But what if I told you that most of these common beliefs about money are simply not true? In this video, we're going to debunk the top 10 money myths that might be misleading you. Stick around because you might be surprised to learn that some of what you've been taught about money is completely wrong. Number 1. You need to be rich to start investing. One of the biggest myths about investing is that it's only for the wealthy. Many people believe that unless you have thousands of dollars lying around, you can't get started in the stock market or real estate. But this couldn't be further from the truth. Thanks to technology, investing has never been more accessible. Apps like Robinhood, Acorns, and Stash allow you to start investing with just a few dollars. You can buy fractional shares of big companies, meaning you don't need $3,000 to buy a single share of Amazon. You can start with as little as $1. Over time, these small investments can grow into substantial wealth. The key is to start early, even if you start small. The sooner you invest, the more time your money has to grow through the magic of compound interest. Number 2. Debt is always bad. Debt often gets a bad rap, but not all debt is created equal. Many people believe that any kind of debt is something to be avoided at all costs. However, this isn't necessarily true. While high-interest debt like credit card debt can be detrimental to your financial health, not all debt is bad. For instance, taking out a mortgage to buy a home can be considered good debt because it's an investment in your future. Similarly, student loans can be seen as good debt if they lead to higher earning potential through education. The key is to manage debt wisely, ensuring that you're borrowing for things that will grow in value or enhance your earning power, rather than for depreciating assets or unnecessary purchases. Number 3. Credit cards are evil. Credit cards often come with a bad reputation, but they can actually be a powerful financial tool if used correctly. The myth that credit cards are evil stems from the fact that they can lead to debt if not managed properly. However, credit cards can offer benefits such as rewards, cashback, and travel points. The key to using credit cards wisely is to pay off your balance in full each month. This way, you avoid interest charges and only spend what you can afford. Additionally, responsible credit card use can help you build a strong credit score, which can save you money in the long run by qualifying you for better interest rates on loans and mortgages. Number 4. Renting is just throwing away money. You've probably heard the saying, "Why rent when you can own?" The belief that renting is just throwing money away is a common one, but it's not always true. While home ownership can be a great investment, it's not the best choice for everyone. Renting can actually be a smart financial move depending on your situation. If you're unsure where you want to live long-term, need flexibility, or can't afford the costs of home ownership, like maintenance, property taxes, and insurance, renting can make more sense. Plus, the money you save by not owning a home can be invested elsewhere, potentially earning a higher return than the appreciation on a home. Number 5. You should save what's left after spending. Many people follow the habit of spending first and saving whatever is left over. But this approach can seriously hinder your ability to build wealth. Instead, you should flip this process. Save first, then spend what's left. This method, often referred to as paying yourself first, ensures that saving becomes a priority. Whether it's contributing to an emergency fund, a retirement account, or an investment portfolio, setting aside money as soon as you receive your paycheck helps you consistently build wealth over time. Automating your savings can make this process even easier, so you don't even have to think about it. Number 6. It's better to buy new than used. There's a common belief that new items are always better than used ones, but this isn't always the case, especially when it comes to large purchases like cars. New cars, for example, depreciate the moment you drive them off the lot, often losing 20–30% of their value in the first year alone. Buying used or certified pre-owned items can save you a significant amount of money while still providing you with a quality product. This doesn't just apply to cars. It can also apply to electronics, furniture, and even clothing. The key is to do your research and make sure that whatever used item you're buying is in good condition and offers the features you need. Number 7. You don't need an emergency fund if you have a credit card. Some people believe that having a credit card is a sufficient backup plan in case of emergencies, but this is a dangerous misconception. Relying solely on credit cards can lead to high-interest debt that's difficult to pay off. An emergency fund, on the other hand, is money set aside specifically for unexpected expenses like medical bills, car repairs, or job loss. Having at least 3 to 6 months' worth of living expenses in a savings account can provide you with financial security and peace of mind, allowing you to cover emergencies without going into debt. Number 8. More money will make you happier. The idea that more money equals more happiness is one of the most pervasive money myths out there. While it's true that having enough money to meet your basic needs is crucial for well-being, there's a point where more money doesn't necessarily lead to more happiness. Studies have shown that once you reach a certain income level, enough to cover your needs and a few wants, additional income doesn't significantly increase happiness. Instead, factors like relationships, experiences, and personal fulfillment tend to have a greater impact on long-term happiness. So, while it's important to manage your money wisely, don't fall into the trap of thinking that more money will automatically solve all your problems. Number 9. You should avoid risk at all costs. When it comes to money, the idea of avoiding risk is often seen as wise. But in reality, avoiding all risk can actually be detrimental to your financial growth. Playing it too safe, such as keeping all your money in a savings account, can result in your wealth being eroded by inflation over time. Investing involves risk, but it also offers the potential for higher returns. The key is to find a balance that matches your risk tolerance. Diversifying your investments, spreading them across different asset classes like stocks, bonds, and real estate, can help manage risk while still providing the opportunity for growth. Remember, taking calculated risks is often necessary to build wealth over time. Number 10. Financial success is all about luck. Finally, one of the most dangerous money myths is the belief that financial success is all about luck. While luck can play a role, it's not the only factor. Hard work, discipline, and smart decision-making are the real keys to building wealth. People who achieve financial success often do so through careful planning, setting goals, and making informed choices. Whether it's budgeting, investing, or continuously educating yourself about money, taking control of your financial future is within your reach. Don't let the myth of luck stop you from working towards your financial goals. These 10 common money myths can seriously hold you back if you believe them. But now that you know the truth, you can start making smarter financial decisions that will set you up for long-term success. Remember, financial wisdom isn't about following old beliefs. It's about understanding the realities of money management. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss out on more valuable financial tips. Thanks for watching,